If you've been following along with the news lately, taxation of Social Security benefits has been a pretty popular topic, and for good reason. There's a lot of discussions that's happening right now as we gear towards another presidential campaign. But it's also important to understand, how does taxation of Social Security actually work? I think many people would be surprised to know that Social Security benefits haven't always been taxed. It changed in the 1980s and then again in the 1990s under both Republican and Democratic presidents. What we want to cover today is to determine, is your Social Security subject to federal income tax? The way that we'll do that is by discussing how exactly is Social Security taxed, are the thresholds that you need to be aware of, and what things can you consider to minimize that tax or eliminate the tax? And how important is it that we avoid having our Social Security benefits be included in taxable income? If we haven't met yet, my name is Cieniewicz. I'm a CFP professional from Hyperion Financial. What we'll discuss today is educational only and general in nature, and is not meant to be taken as any type of specific investment advice. There's a couple terms we want to discuss today to make sure that you understand how exactly is Social Security taxed. We're first going to start to understand that by talking through a term called provisional income. So provisional income really will apply to your Social Security benefits in particular. It's set by the IRS, and the way that it's determined is it takes your adjusted gross income. It then adds back any tax-exempt interest that you would have earned from that year, and then it takes half of your Social Security benefit. This provisional income then is then applied to those thresholds, and we'll cover those in just a second. And if your provisional income is over these thresholds, that will then determine how much, if any, of your Social Security is subject to income tax. Let's talk through the filing statuses and the thresholds that actually are in place. As a married couple, you can file either married filing jointly or married filing separately. Quick note for those that are married filing separately. If you're living under the same roof, what you will notice is that the married filing separately status will automatically have the threshold of 85% applied to your Social Security benefit. So 85% of your Social Security benefits will be considered taxable. And if you're living separately, what will end up happening is you will then use the single brackets. Specifically, some of the thresholds, what are the breakdowns? So the first one is for those single filers. The provisional income of under $25,000 means that none of your Social Security benefit would be included in your taxable income. The next threshold then is from $25,000 to $34,000. If your provisional income falls in this threshold, 50% of your Social Security benefit would be considered taxable. We then jump up to the next threshold for single filers, $34,000 and above. That's where up to 85% of your Social Security benefit could be included in taxable income. For couples who are married filing jointly, that first threshold will be $32,000. Any provisional income below that $32,000, no tax on Social Security benefits. The next threshold is $32,000 to $44,000. That's the 50% threshold. And then the final threshold is anything over $44,000. 85% of your benefits would be included in taxable income. An important thing to note is that these figures and these thresholds have not been updated since the early 1990s. They are not indexed for inflation, unlike our federal marginal tax brackets, which you may have noticed are. And if you've been following in recent years, inflation has gone up. Another thing that you'll see is if you are collecting or you're planning to collect Social Security does offer cost of living adjustments. So as your Social Security benefit increases, these thresholds have not, and they have not in over 30 years. If it continues at this pace, what we'll notice is that many people will continue to cross these thresholds as they begin to earn more in Social Security. Let's take a look at 3 quick examples of how this would apply, and we'll use one person and talk through some of the different criteria which she would have. So what we're first going to use is Lauren Paxson. She has a Roth IRA and a Social Security benefit. The Roth IRA, it's a total of $15,000 per year, which is a qualified distribution. She also has $20,000 a year of a Social Security benefit. She doesn't earn any tax-exempt interest. So total, she's taking in $35,000 of income. However, what we notice is that her AGI in this case would be 0. There's a tax-free withdrawal of the Roth IRA. Her AGI before any Social Security is 0. What we then want to take into account is her Social Security benefit, a $20,000 a year benefit. We take half of that amount, and that would be $10,000. It gives us a provisional income of $10,000 per year. As we discussed earlier, she doesn't even meet that first threshold. Let's change some of the figures a little bit so that we can talk through what the 50% threshold would look like. Let's say instead of a Roth IRA, Lauren has a traditional IRA, and she's taking out $20,000 a year from her traditional IRA. We'll keep the other figures the same, but in this case, what we'll do is we'll take a look and see that her AGI is $20,000 a year as opposed to the previous example of zero. We again take that Social Security benefit and we divide it by 2. That gives us $10,000. When we add the AGI and the half of the Social Security benefit, we get a total of $30,000 of provisional income. What we then want to do is take the provisional income of $30,000 and subtract the first threshold number, and we'll get $5,000. What we then do is we find out that 50% of benefits within this range are considered in taxable income. So we take half of the $5,000, we get $2,500. That $2,500 is what's included then in taxable income. So when we actually do the math on this, what we find is $2,500 of the benefit is actually included in taxable income. We take that $2,500 and divide it by 20,000. 12.5% of the Social Security benefits would be included in the taxable income. I think a common misconception would be people think that once you cross this threshold, half of your benefit is included, and that's not the case. Instead, it's only the amount over the threshold, and then again, you subtract what the difference would be. So you could be in a situation where less than 50% of your benefit is considered in taxable income, but not zero. If we take another look at an example, something that would be the maximum level that she would have to pay. Instead, what we're going to say is we're going to double up the amount that she had to take out in a given year from her traditional IRA. We're keeping the other figures the same. So she's taken out $40,000 from her traditional IRA, $20,000 from Social Security. The $40,000 of the traditional IRA withdrawal would be included in her AGI. What we then look at is, again, half the benefit of the Social Security gives us a provisional income of $50,000 per year. This is where, since we know she's already eclipsed the first threshold, we know that at least $4,500 is going to be included in her taxable income. And the reason that is because, again, you take the $34,000 minus $25,000, that gives us $9,000. Half of that figure is $4,500. What we then want to do is take the rest of her provisional income and then subtract it by the higher threshold. That number is the $50,000 minus the $34,000, and it gives us $16,000. 16,000 times 0.85 gives us $13,600, since 85% of her benefit would be included in this. What we then do is we add these figures together, and it's over $18,000. But since this total number is over the 85% threshold, remember that up to 85% of your benefits would be included in your taxable income. So we can take 85% of the $20,000 figure, and that's $17,000 of her $20,000 benefit that would be included in her taxable income from Social Security. So for individuals who have a fairly high provisional income, there's really not much that can be done other than understanding you're likely going to be and stay in the 85% threshold, and that number will be the figure that you pay year to year and is included in taxable income. There are some additional things worth noting, though. To this point, we focus strictly on the federal income side, but it's also worth noting that there are currently 9 states which are taxing Social Security benefits in some form or fashion. Those 9 states, as of this video, are Colorado, Connecticut, Kansas, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. These states each have their own separate rules. As we know, there's federal tax law and then there's state tax law. State tax law will vary as we cross each of the state borders here, but what we also want to keep in mind is these rules are constantly changing. As a result, you may or may not be in a position where you have to actually pay any state tax if you live in one of these states. And it's worth noting that you should be following exactly what is your state's rules with how Social Security is taxed. The last thing to keep in mind is to see, as always, we want to find how can we pay the least amount of taxes possible. We obviously want to pay our fair share and pay what's legal, but you want to minimize the tax whenever that is the case. For some people, that may be planning around the provisional income figures. If you can find a way to limit the amount that you're able to take from a pre-tax source and instead take it from an after-tax source, thus lowering your AGI, it's worth a potential consideration there. But if you have a provisional income that's going to consistently be in that 85% threshold and not particularly close, for example, people that have a very large required minimum distribution, or people that may have a large amount of tax-exempt interest that they get from year to year, others who have a pension from a prior employer, you may not be in a position where you are going to be near one of those thresholds where you could plan yourself around this. Again, keep in mind that these figures, these thresholds, have not been indexed for inflation over the years. Therefore, as time goes on in retirement, you could find yourself consistently in the 50 to 85% threshold, and it's unlikely that you could find yourself in a lower threshold because expenses are not going down. So if we're looking at this from a pragmatic standpoint, depending on your provisional income from year to year, you may want to consider things such as the timing of your IRA withdrawals. You may want to be looking into things such as Roth conversions that can help lower the amount of the required minimum distribution you would have in retirement. Still, others may be able to look at other after-tax sources from year to year, consider things such as the Roth IRA, an HSA, a non-qualified account. If you're able to lower your adjusted gross income, it can keep your Social Security benefit in a position where your provisional income will stay low. But for others who are well beyond this figure, it's probably not worth worrying about the tax that you have to pay on Social Security. Instead, strategies that you may be wanting to look at are ways in which you can lower your required minimum distribution over time. It may instead make more sense for you to try and lower your IRMA surcharges that you're paying. There are other tax strategies that you can look to utilize, and for, again, many people, these indexed figures may not be applicable to you, in which you can pay in the 50 or the 0% threshold for Social Security benefits. What you want to try and do your best to do is lower your lifetime taxable liability. For others yet, that may include capital gains planning, which you can look to try and pay at a 0% rate as opposed to the 15 or the 20% rate. Ultimately, your goals can be the same as other folks, but the strategies behind them could be very different. If you haven't done yet, now would be a great time to consider subscribing. Also, make sure to give this video a like and share it if you find it useful. If you haven't also yet, it'd be worth checking out HyperionFP.com. That's where you can learn more about myself and some of my other team members and the type of planning that we do to help pre-retirees and retirees pay the lowest amount of tax possible, in addition to making sure that they're able to retire on their own terms.